be a very high value market, so I'm not going to say no venture will ever invest in a sub 100 million market. But the reality is that if you are looking at achieving the returns that I showed in that table before, you probably need to look at very large markets that are above 100 million in terms of attainable size. And so a few other points, finding your positioning, of course, is important, understanding your competitive environment, and how you build barriers to prevent other competitors from entering the space. So that can be regulatory, that can be skills, that can be a number of things, depending on your industry that you need to look at. Showing investors that you understand the dynamics of that is absolutely essential. The third part is really technology and operations, right? I think a lot of companies, when they start, they don't necessarily have all the tech skills in-house. And it's kind of okay to start building an MVP with third parties, or you don't have a full-time CTO in the company. But really what investors look at is that defensible advantage that you have, right? And that's the technology. So at some point, and relatively early on, this needs to be internalized. If there's a way to even protect that technology with patents, that's also something very valuable to investors. And so once you've built or decided to build this technology in-house, then you need to make sure that it's both very qualitative and also very scalable. When you start, you tend to do a few things manually, and you push, kick the can down the road, saying, okay, I'll manage this later. But this will become your biggest issue as you grow the company. Quickly, revenue and growth. I think these are probably more obvious, but because if you don't get revenue, of course, at some point you run out of cash. But I think some of the underlying metrics here that investors will look at to understand how you measure growth are key to understand. And so the cost of customer acquisition is a very important metric. How much are you spending to acquire a customer? And then you need to look at LTV, which is the lifetime value of a customer, how much this customer is bringing the company. And if the ratio of CAC to LTV is below 3, you're not exactly optimizing your acquisition channels. And so back to the first point on this slide, you need to assess these different channels so that you reduce your cost of acquisition to optimize for that ratio of CAC to LTV. LTV to CAC. And so there are different types of acquisition channels that you can test. There is the inbound versus outbound. There is the ones that scale and the ones that don't scale. Usually when entrepreneurs start, they start with the outbound that don't scale. And again, that's fine, but you need to be able to take the key learnings from that and optimize your acquisition process. That's the maturity that most investors will want to look into to decide before making an investment. Financial performance and management, I mentioned before, tracking some KPIs is essential. And of course, managing your cash and showing investors that you understand the notions of basically runway, how much the cash you have in the bank allows you to go, basically. And then the last part, well, I cheated because I think nobody noticed, but I missed one, so I jumped from 5 to 7. But the last one is the fundraising part, and I'll dive into this a bit further, but basically you need to have a strategy to raise money. It's not just about reaching out to investors and expecting the money to flow in. It just doesn't work. And the first point, of course, for that is to have a quality pitch deck. What I like to say on the pitch deck is that if, I don't know if you have a nephew or a niece who's 10 years old, he doesn't get the deck, it's probably not a good deck. If it's not something someone who has no experience in your field can understand, you probably need to revisit that deck. So that was for the investment readiness. I have no idea how I'm doing it on time. You don't either? Okay, okay, cool. Do we want to stop for questions or? Okay, so I'll pause here, and if any of you have questions before I jump into the. What entrepreneurs expect is, when they reach out to VCs, they expect a very quick yes or no. They send me an email and say, hey, we're doing this, I'm raising 1 million, do you want to invest, right? And you just, one point in time, I have very limited information on what you're doing, what you have achieved so far. I just have a deck, sometimes not so good deck, and I need to make a decision, right? That's very difficult. That's what we do, but that's very difficult to have the right assessment based on that one single data point. And it's even more difficult that a lot of your peers are doing exactly the same thing. So it's a matter of, comparing you to the other people I have received a deck from, and that's not making my life easy. I don't know how many dots there are here, but just to give you an order of magnitude, at Seed South Africa Ventures we get between 2,000 to 3,000 opportunities per year. And we're very grateful for that, but we need to filter them through. We invest in less than 1% of that volume. And so you need to stand out. And so one way to stand out is to actually build a relationship early with investors. Don't reach out to investors only when you need the money. Anticipate that. Build a relationship, show progress, send newsletters. Even if they don't respond, don't expect an answer. But showing that you're actually building that relationship, that you're actually nurturing that relationship is absolutely essential if you want to stand out. And so there are 5 questions that you need to ask yourselves when raising funding. Why are you raising funding? When? What for? Sorry, how much? Who are you talking to? And how are you doing it? The why seems an obvious question, but I think the purpose of this question really here is to highlight that investors, they don't fund shortages of capital in startups. They fund objectives, they fund milestones, and they expect returns that come with these milestones achievements. So you need to be able to articulate very clearly what this funding that you're raising is going to help you do. And if you have raised a round before, you need to be able to explain what you have achieved with the funding that you have raised in the previous round. Have you actually delivered on what you said you would be doing or not? That's a very strong sort of point for investors to assess how you do, right? And what kind of relationship we can build together. The second point is when. When are you raising capital? And again, back to my previous slides, there's a difference between when you need capital and when you want capital. When you need capital is usually too late. Fundraising needs to be anticipated. It can take 2 to 3 months. That's the best case scenario. The reality is that in most emerging markets, including in Africa, the funding round, it's very rare that it takes less than 6 months. So if your runway doesn't get you there, you probably haven't anticipated enough. So that's a key question to ask yourselves. How much capital are you raising? Well, there are 2 approaches here. Either as much as possible, or, again, I have my fundraising strategy. I know what milestones I want to achieve, and I have tied my capacity to attain these objectives against how much funding I'm raising. And of course, the consequence of that is that also you will be building a roadmap for the next fundraise. and anticipate how much dilution you get into the company to reach the next milestones after this very fundraise. So it's not so much about, you know, only this immediate round. You need to show that you have thought about the long-term plan to raise funding through the different cycles that I described at the very beginning. The who question is probably the most obvious one. Bombarding every single investor with your pitch deck is probably the least efficient strategy to achieve anything. And I would advise you to divide by 10 the amount of time you spent doing that, but again, trying early to build relationships, as I said, and trying to understand sort of more precisely what fit there is between what you're doing and what the investors are investing in is something also essential that will save you a lot of time and avoid a lot of frustration. And trust me, it's as frustrating for entrepreneurs as it is for investors. We spend 99.9% of our time saying no. I can tell you, I don't like saying no, and I don't like to say no to some very talented entrepreneurs just because they're doing things that I feel personally are great, but this is not my mandate. And I have a pretty generous mandate, so it's very difficult. Anyways, so the last question is how, and I think here it's a matter of process. If you are someone very organized, there's a good chance you can do that by yourself. If you feel you're not that organized, there are plenty of advisors that will support you with the fundraising process. That includes building that list of investors that are a good fit for you, creating the data room, and following up with the investors. Investing is really a process. It's not something that you just, you know, magically happens. You need to have a tracker with all the investors that you've reached out. Don't be afraid to chase. And really your understanding of how investors work will be the key to your success. I will finish with just one slide to show you, I think, an interesting data point on how powerful a deck can be or not. So this data is extracted from one of the most, so DocSend is a platform that allows you to track how much time people are actually spending on what slide in the deck that you send. And so this is the performance of a real-life example, a deck that was tracked, one of the most circulated deck within the investor community. 15 slides, and so the first slide, of course, 100% of people who opened the deck arrived on the first slide. So that's an easy one. But then you see that about a third of the people who actually got the deck arrived on slide 2. I don't know, either they didn't like the slide, the first slide, the picture, the title, the whatever. But that's to show you, like it's hard to get in. Okay, so you really need to chase investors. You really need to insist. But at some point, when they say no, stop insisting. But until you get an answer, it's okay to insist. But then comes the bigger point. Between slide 2 and slide 15, you've lost another almost 50% of the people who were still with you at slide 2. And I think that shows you one thing, is that you really need, back to my definition of investment readiness, you really need to be able to show in your deck what are the key things that investors will be expecting. How do you position yourself compared to their own objectives? And I think this is why this graph is dropping so dramatically towards the end. Another data point that's not on this slide, but that's linked to it. The time spent on this particular deck, the average, was under 30 seconds. I let that sink with you. But reviewing 15 slides in 30 seconds, you need to be very straight to the point, very clear. And you have one chance to make a first good impression, and so keep that in mind when you build your decks. Thank you.